I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, it's good to be with you, and there's a lot of fascinating things going on out there in the marketplace.
Crude oil seems to be holding its own longer into the season than it normally does. What's behind crude?
Yeah, it's, of course, the big commodity that everybody follows. And it's been weak down, sold off down to the 42 level in June. And that's when we were looking at all the industrial commodities, base metals, mainly base metals and crude, and looked at our work and said, no, this is going to rally right through August, perhaps into September. And the base metals did do the rally, but crude oil did rally through July and got up to $50 right at the 1st of August. It was going sideways, and then the storms threatened, and then the storms arrived, and crude oil got pushed up and down and all around, and finally, in late August, got down to 45, and 45 and change. And then with the threats over, it's had a very nice rally, sort of, we call it a catch-up rally, and a few weeks ago we had a target of 52 to 53 for this move. And it got to about 52.75 recently, like last week, and that was just a couple of days ago. And so there's resistance at this 52 to 53 level. The other one was that it's generated one of our sequential sell signals. And that's based on pattern. You don't have to have a huge amount of momentum on that one. So we're at resistance, and it's giving a technical sell. And this is quite important because you can have seasonal lows for crude oil out in December or January of the year. And, of course, that goes back to 2016. First early in the year in February when it sold off down to 27, and that actually then goes back to 2014 when crude was at 105 to 106 level, and that's when we did our study on the, sort of called it peak oil, and pointed out that it was vulnerable to the same sort of price decline that natural gas had suffered. And gas was early to move based on the fracking story. And then we pointed out that the copper mining had gone through a revolution in 1910 when the huge porphyry copper deposit at Bingham Canyon, that's just south of Salt Lake City, Utah, was put into production as an open pit operation. And Jim, that mine at Bingham, it's still operating, and I think it's the biggest man-made hole in the ground existing. So then in the 70s with gold mining, you had at Carlin, Nevada, where Homestake then no, it wasn't Homestake, somebody else. Anyways, were able to put into production a large low-grade gold system, and that was a revolution in mining gold. And then also, in and about that time, you had the leaching operations, which was also much more efficient. So this is the nature of engineering and capitalism, is that one will find more efficient ways of doing things. And in this case, the fracking had been going on for, I don't know, 60 or 70 years, whereby an existing oil deposit could be freed up by banging it with high-pressure water fluids with fine sand, but then hold the cracks apart. So, but you had that, and then plus they had the ability to direct the drill bit so that you could go from a vertical hole to a sideways hole, and that did it. And suddenly you're into a vastly different world of oil discovery, oil development, and oil production. And at the same time, you have the old remnant of a cartel attempt with OPEC. And these guys are still in the supply-demand world, where if you shorten supply, cut back production, you'll get a price rise. But then if you're selling less of it to get the price rise, you're not maxing out on the economics. So anyways, these fools in OPEC managed to get themselves convinced, and they really did some pretty good price or production cuts and more or less followed the rules. So then what did you have with the operators on the shale deposits in North America? You had happy is what you had, because you had an artificially high price that you could feel confident of selling forward into in the high 40s, when your cost may be about 20. So it's wonderful. Here you got a struggle going on between the old mindless world of coercion with a cartel attempt and the always successful world of free markets. And so it's working. Crude oil can go down to much lower prices. In 2014, when it was about 105, our forecast was that relative to gold, it got complicated, Jim, but it could fall to 1/3 of that level or 1/4. And then when you turn that into, because it happened so quickly, in like a couple of years, into just straight dollar terms, that worked out to 1/3 was the 37 level. And if it fell to 1/4 of the high, that was about 27, which it did get to. But that was on a trading panic, the 27 level. So it's possible that crude oil could go down to the 30s, say, on annual averages, and then that'll really separate the efficient producers from the inefficient. So it'll be interesting. We're in a mighty boom now, well, a great financial boom. And on the stock market, it's looking like excesses have been met. We've been discussing this. You've got excesses on valuations, and the chart we like is the one where you compare labor cost in the U.S. to the S&P, and it's like the number of hours you have to work in order to buy 1 unit of S&P, and it's up higher than reached in 2000, which was breathtaking levels, and it's higher than that. So I like this one because, hey, Jim, can you see wages rising, say, 20% over the next year? No. But if you're a stock analyst and you've got your favorite stock and the multiple on it is looking high, and you know the customer wants to buy the stock, so all you do is raise the earning estimate forward say, oh, sure, they're going to earn 20% more next year, which then makes the stock a reasonable value, which bulls really like. So this comparison to the average wage, I think, is a good way to do it. So one, stock market very high. Two,
and Bob, maybe we can talk about that right after the break.
Sure thing.
We'll have more with Bob Hoye right after this.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Welcome back. We're speaking with Bob Hoye. Bob, what are you going to see in the stock markets over the next short period?
Yeah, well, this, as I said, we've had achieved, that's a good word, achieved exceptionally high valuations. You've also achieved very good momentum rushes on these speculative moves. And you've also had very high sentiment figures. Sentiment figures is the number of people who are really bullish out there, and they've been very good. And our target in the U.S. market was that there could be a good thrust into September. And then that could be the final thrust. And we still think that. We're getting some technical indicators this week that are similar to the ones we got in October of 2007. And the high for the S&P in 2007 was October the 11th, and it rolled over. So now there are some things missing that are not a threat now but could become a threat, and one is the yield curve has been flattening, which happens in a boom. And in a number of booms, the yield curve can actually invert where shorter rates are higher than long rates. But that's not necessary. It just has to approach inversion, and then when it reverses, it gives a warning. It's not reversing yet. Then the other one is credit spreads, which is the difference between high-grade and low-grade bonds. Spreads have been narrowing, and in August, with the uncertainties there, we had the second breakout on attempting to reverse the trend to widening, which would be a bad thing. And it's moved back from that. So, but any move in the credit markets, a reversing to steepening for the yield curve, and another go at widening for the spreads would be a warning for us. So, and this, of course, is not going to be a good environment for a weak, big stock market. Is not good for gold and silver shares. So they will be vulnerable. The other thing that can happen if we go into some credit concerns is that the U.S. dollar would firm up, and that's not going to help gold and silver, and it won't help the industrial commodities. The other industrial commodities that did have a rally, like iron ore price chart soared up to, had a good move right up to the 1st of September, and quite an impressive drop since. And then also the same thing with metallurgical coal, rally up until around the 1st of September and a fairly good drop since. So, and those are sort of relate to China and the whole global industrial side. So if you've got those two industrial commodities weak, that's sort of like, whoa, you better watch out, guys. So we're watching those closely.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Bob Hoye. Bob, the latest financial statistics out of Ottawa say July flatlined, and that's after we had over 4% growth in the spring. Was the Bank of Canada too quick to pull the trigger and up interest rates?
Oh, no, I don't think so. They're operating on a bureaucratic mode where under certain conditions you do certain things, and on their playbook, raising the rate is one thing that's part of, as I say, part of their playbook. But we look at it in the U.S., the T-bill rate was rising, well, from next to nothing up to 1.18% in July. And it's now come down to about 106, and not much. But we watch that closely because in the 1929 boom, the T-bill rate went up until June and went down, and it was the leading item. And I think the reason why the T-bill rate goes down is that the big money, the careful money, looks at the boom and says, oh, and starts buying safety and liquidity, which is the T-bill. So the lesson from this, Jim, is that when the T-bill rate is rising, it says the boom is on. And when the T-bill rate goes down, it says the boom is getting over or off or whatever. But the history of HIS going back to the 1870s is that the senior central bank, on moving their administrated rate, are usually 3 or 4 months behind what's going on in market rates of interest. So, the Bank of Canada is doing its own playbook, but in some months from now they'll look and realize that, oh, well, maybe they shouldn't have raised it. But the thing is that most folks should look at market rates of interest rather than what a committee of learned intellectuals are doing with their administrative rates. So there's far too much attention given to this business about what the central bank is going to do. And the reason why it doesn't deserve it is that the central bank, at times of great excitement in the credit markets, follow what's going on in day-to-day market rates of interest. So they're not running the show, they're following the show.
Bob, thank you so much for chatting with us.
Jim, I always enjoy it, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or our other guests or for the show, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.